Welcome to our monthly real estate for March 2023. There's a lot of things that happen across the commercial real estate space as well as residential. We're going to dive right in. First thing we want to check is our interest rate. So it's not these big numbers here, but the small imprints that you see right here. So we are at 6.375% interest rates on a 30-year fixed mortgage on average. And then for a 15-year, we're at 5.3 quarters. I have my reasons why I don't focus on the 15 year as much, or why I don't encourage 15-year mortgages. However, it can work for you depending on your investment strategy, because the goal is ultimately to save on interest payments, and there are different ways to go about doing that. I have another video which I shared how I think about it when it comes to strategizing for such things. So we see that interest rates are still high, but I'm going to dive into this article that talked about the commercial lending space. So what we consider commercial is those big sky high buildings that we have, things that are more than 5 units, where you have buildings with 10, 15, 20 units. All those are considered pretty much commercial, as well as places where you have dining, restaurants. Those are not your typical residential spaces. Therefore, a lot of transactions, the way the deals are constructed, are different than residential. You typically have your 30-year, 20-year, or 15-year fixed mortgage on a residential space. However, for commercial, it's different. The down payments are higher, as well as the interest rates that you're paying. At one point, I was trying to purchase a real estate building, a law practice that was inside of it. It wasn't dental. A law firm existed there, but right before COVID, they kind of went under and they were trying to liquidate as much. I went to see the building. However, the deal fell through because I asked them to generate certain paperwork of some of the works that was done, and it didn't quite happen. I had the money at that point in time. However, I used it on other assets towards retirement, as well as prepping our portfolio to be diversified across stocks and crypto as well. So that deal didn't put through because, one, I always ask God for guidance in terms of what should I do next, and if things don't go as smoothly and there's a lot of hiccups along the way or blockades, it's not happening, then I trust that was not meant for me. And no hard feelings, it didn't quite work out in that manner. So building that tolerance is also part of the learning curve for me, as well as many other real estate investors. As you go along, you kind of see how people react, and you know what deals are meant for you to spend the time on and what deals you should not be even bothered with at all. So diving into this article, there's a lot of pressure that's going on, and this outlines here right here. This year, roughly 270 billion in commercial mortgages held by banks were set to expire, and according to TREP, 1.4 trillion dollars mortgages over the next 5 years. So there's a lot of money at play here. When it comes to commercial real estate, we're not talking about the millions, we're talking about billions, trillions. It's a lot that are involved when it comes to these things, right? There's a lot of fewer deals that are getting done because of the pressure. When you have these banking collapse that happen with Silicon Valley Bank as well as Signature banks, it creates fear a little bit. It forces other banks to tighten up their lending policy, so that way they're not getting all these other people to lend money to. If you are not aware of this, the reason that Silicon Valley Bank fell is due to the fact that you have all this money that people are depositing. As a bank, you're not required to keep all the money inside of the bank. You can actually invest it by law. So what they did was they didn't hold to as much, and they invested in so many different things that weren't bringing back the returns quick enough, because these were like government bonds and things that are more for the long term. So their thinking is that people will leave their assets digitally, right, in place inside of their banks for that amount of time. So in 3, 4, 5 year period down the line, they've made a ton of money off of these people's money that you just let sit there. But a lot of companies that are utilizing Silicon Valley Bank were these big tech giants, right? These new startups, as well as venture capitalists that were just keeping their money there. However, they started liquidating, and it caused the whole spiral effect. One person liquidated, then the next person done it, and before you know it, all these people try to get their money out of that bank as soon as possible, and it caused it to collapse because they did not have the money actually there. It's already inside of assets, and you know you can't liquidate assets that easily, especially if it's in a negative. Like, you really don't want to do that, and then you sell everything at a loss. Banks do it. However, for this instance, it didn't quite make sense for them to do it right there and then. Luckily enough, the Federal Reserves have acknowledged this. Typically, you're insured for up to $250,000 per bank account that you have opened up. But we already know, as big tech companies, you're having hundred millions, even $1 billion stuck inside of these banks that you're not moving around constantly. But when you want your money, you want your money. And being able to liquidate that and you can't, it causes these big banks to fail. So that's pretty much what happened to Silicon Valley Bank. And they went under because they didn't have the money actually available in liquid format. What happened in 2008, let me just bring this up too. We're not seeing quite the same repeat of that. I wasn't around. I wasn't as knowledgeable at the time as well. I wasn't into real estate. I was just getting out of high school pretty much when the downtrend happened and real estate crashed around that time. In 2008, if you're not aware, what happened was people were able to get loans without getting all these proof of income and all these financial requirements established. Banks were just giving people mortgages left and right that they actually couldn't afford. And when you start having too many of that happen, they start defaulting on their monthly payments, and it forces people to go into foreclosure because they can't afford to keep up with these payments. And that's what really caused the 2008 financial crisis. But we're not quite seeing a repeat of that because lending is already tight. I can tell you that for a fact for me, because when I tried to get that investment loan to purchase that building, they required me to have 25% down. Income still had to be tight. And I also had another property I tried to purchase about the same year, but 10 months prior, and I couldn't do it because I had lost the employment, because they require you to have that W-2 income over the past like 5-6 weeks. You got to show proof of that. And there's no real way to get around that because they're all going to call in and use these third parties to verify your income is actually legit. So it's definitely tighter than it has been, and it's forcing people to be very thoughtful about what they're getting themselves into when it comes to applying for these mortgages. So banks don't put themselves in a hole like they did back in 2008. Signature Bank, let me just read this right here. Signature Bank was among the banks that made some of these bets. The bets that this is talking about, let's read the previous paragraph. Smaller banks began ramping up their exposure to commercial real estate in the aftermath of the 2008 financial crisis, as I brought up, which was triggered by a housing bust, and stuck with it even after the pandemic emptied out many city center properties and other forms of borrowing provided by commercial mortgage-backed securities, and life insurers dried up. During the pandemic, as you've seen, a lot of places were emptied out. I remember the American Dream Mall, half of the stores that were inside of that store, and it's the biggest mall, I believe, in the United States, and I'm not too far from it. A lot of the stores were closed permanently because they didn't have the capacity to keep going. People weren't coming into the mall as much. COVID was happening. People were still afraid. The traffic wasn't as where it's supposed to. And they as well themselves, they almost defaulted. So I'm not sure who bailed them out. That's something I might do another video on to see exactly what happened and how they came out of that, because it was fascinating that they're still alive till this day. But a lot of banks get involved in these commercial real estates, and during the pandemic, they bet a lot on things just keep going, the economy to keep going as it is. But we knew something was going to happen. And unfortunately, it was a viral thing that was medically related with the whole coronavirus that caused all this to slow down a bit. It wasn't just the markets bubbling happen, but nature has its course. If it's something that's not defunct inside of the financial system, it's usually something natural, of natural causes, that causes these things to slow down. They cannot keep going up forever. There has to be a slowdown and stop. Signature Bank was also one of the banks that became an aggressive lender in New York City to office towers and multifamily properties. By the end of 2022, it had amassed nearly $36 billion in commercial real estate loans, half of which were apartments. That portfolio comprised nearly one-third of its $110 billion in assets. That is huge. Like I said, these aren't little players. These are big players. So they're banking quite a bit of a lot. And for you to have one-third of your portfolio in commercial real estate loans, right, for these apartments, and we know apartments had to cut off a lot of prices as people were moving from different places throughout the country, is causing a lot of these drawbacks that we're now seeing the effects of them. We weren't seeing it right away because it takes time. You got to default over the course of like 6 months to about a year for you to really see the impact of these things happening to the economy. For all commercial real estate loans, like 80% that are held by banks and $250 billion in assets, that math doesn't make sense. I would expect a lot more, like $1 trillion. But these are the risks that we are facing, and it's called for desperate measures at this point. and you just have to be really careful. If you're going for commercial real estate, I really strongly advise you to think strategically what you are doing. You got to think about your renters. They're not your typical residential folks that you're renting 2-3 bedroom apartments to. These are businesses. You got to ensure that they're going to be alive throughout different stages. There's no way, of course, you can predict what will happen. Coronavirus was unpredictable, but you want to put yourself in a good place so that way when these things happen, you were diversified enough and you can offset it so that it's not impacting you as much. You could hold out for 6 months, a year, and be able to continue to dive back in. Of course, I can't speak on the level of assets that these banks are having. Like, we see that this is huge, right? The level of assets that these banks are having are just humongous. 250 billion is insane. I haven't even reached like $5-10 million worth of real estate yet for me to really fathom the level of pressure that's on these banks right now. But that's the state of where things are right now at the moment. And we'll see how things turn out to be in the near future. But I want to jump back to another article here that breaks down a lot of things that's been happening on the residential side of things, right? So this article pretty much gave us a good summary of what's been happening when it comes to inventory, pending sales, things that were off market, the amount of time that it took for some transactions to actually happen. Overall, we're seeing that as rates are increased, which is expected, there should be less amount of enthusiasm for people to want to buy because it's more expensive for them to actually purchase and get these mortgages. But when interest rates drops just a little bit, we see that people are running back into the market. Buyers are trying their best to see what they can purchase because those 0.5% rates, sometimes for like commercial banks who are investing in heavy into real estate, could be a huge difference. Like for me, for example, I have a 3.25% interest rate. If I was to do the same mortgage that I have now on 7%, I would be paying almost $2,000 more per month, right? So it almost doubled the amount of interest rates that I would be paying, right? And it's about a $2,000 payment for a home that was worth a little under $600,000 purchase price. So these people are doing $1 billion of transactions. So you can imagine, right? If I take $2,000 to $600,000, that is 3%, very tiny, right? So if you think about their monthly payments being an increase of just 3% from the previous interest rates of around the 3% ranges to now being the 6 to 7%, and it's about a 3% effect on your total purchase price, that's a huge impact and difference. Just to give you a quick math, imagine they're doing $60 billion, right, of monthly payments that are actually happening. $600 billion of actually purchase price, let's say, for example. Their monthly payments would be increased, right? If we use the same math of 3%, will be $180 million, which is a huge amount of money. This is on a monthly basis. That's quite a bit. So therefore, that's why I do say it's always good that you analyze the market, see what's going on, ensure that you can actually afford the things that you want to do. When things are good, you want to make sure you're stocking up and prepping, saving up, savoring for a rainy day. And then when things are bad, you're kind of not going crazy as well. There are times that you want to enjoy yourself, be able to go out on these vacations, do these things, but you got to pay attention to the economy. You got to fluctuate. You got to know when to spend excessively when you really shouldn't. So really be mindful of that. So the median home sale price was $358,000, and median sale prices fell in 24 of the 50 most populous U.S. metros. So you can consider like New York, California, San Francisco, Los Angeles, those areas. But this is actually calling it out here. San Jose, California, 14.5%. San Francisco, 13.6%. Austin, Texas, Oakland, California, and Sacramento, California. We're going to check the inventory on these two, see what sell prices are, how many of these have like price reductions that actually happen. Sell prices increase most in West Palm Beach, Florida, Milwaukee, Fort Lauderdale, Virginia Beach, and Miami. Let's dive into these and see exactly what's been happening. So I'm going to look at San Jose, California to see if things are actually really bad over there. So let's take a look. Let me make sure I reset everything. Okay, so it's showing me everything. So let's see what multifamilies, or there are 32. And let's see how many are price reduced. 7. That is about 20%. I always say when it gets closer to 30, you definitely want to be on the lookout for and see what's happening. But if this wasn't multifamily, let's see if we looked at all homes from 500 to 73. So it's around 10%, a little over 10% if we look at the overall home. But for multifamilies, it seems like it's about 20% of homes that are on sale were price reduced. Let's check another area here. They mentioned San Francisco. I know San Francisco is one of the most expensive cities around the country. So there's about 1,000 homes that's available for sale right now, and out of that, almost 20% that are price reduced. It's not at the point where we could say it's a crash yet, but we are seeing a bit of traction that is happening going on over there. Look at these condos, $6.5 million. I wonder who is buying these condos. Lands for sale. The cheapest thing you could get a studio for $300,000. Wow. Yeah. I don't think you'd catch me buying over there. Not for these prices. This is insane. Let's do a reset. 3,000 homes for sale, and price reduced was almost a third. We're at 845. That is a good indicator that there is something going on over there. It might be worth your while to check it out for potential opportunities for you to actually buy, either for long-term hold, because right now I think that's what makes the most sense. I don't see anybody really buying to flip as much. I think it's really more buying to hold, rent it out, and then when things get pretty good, prices are going to surge again. When interest rates drops, home prices go up. And as the economy stabilizes through all this inflation, these bank failures that's happening, we're going to see that. Because when things come out on top, they come out top with champagne showers. It'd be pretty good for those that really held on. So Oakland, California is another place. I don't think I check much of Oakland, California. But let's see. 600 homes, price reduced. It's about 90. So that's over 10%, but not more than 20. It's still a decent amount. But let's see their multifamily, if that changes the story a bit. So they have 114 and 23. So it's about 20% if we look at multifamilies that are happening over there. But let's look at the sales price increase. West Palm Beach, Florida. I want to see what that's all about, really. 1,000 homes, price reduced, 230. It's over 20% actually. But it seems like they had a bit of increase. There seems to be quite a bit of demand still over there in that case. That's probably what it is. Sometimes when there's not enough inventory, it causes prices to surge. Even throughout bad economic times, people are still enthusiastic when it comes to there's not enough demand. So they think that they are about to miss out. So they have this fear of missing out. So instead of waiting a bit, they just want to jump right in. And sometimes it works out. But at other times too, this can be, if you're not prepared for it and not thinking about this for a long-term strategy, like you're only want to hold this house for a couple of years, it may not work out in that instance. So I always say buy things that you can hold for the long term. So that way it really is always a great time to buy if you look at it that way, because the price that you buy now in 10, 15 years, your home price is going to be way higher than that. Even if we are at a downturn in 10, 15 years, the cycle continues, but the down points are never as low as they were previously. Like, we're not going to see home prices as low as they were in 2008 at all. That's not realistic. Stock prices maybe, but not home prices. Doesn't happen for real estate. The monthly mortgage payment on the median asking home price was $2,500, which is like paying New York rent pretty much. I think like a 2-bedroom apartment goes for that in New York right now. Still pretty high up. So if you're a New Yorker watching this, you're probably like, man, I should jump on a mortgage, and I'll encourage you. You should definitely do that. Pending home sales were down 17% year over year, which we do expect as interest rates go up. That's expected. And pending home sales fell in all 50 of the most populous U.S. metros. They fell most in Las Vegas. Let's check Las Vegas. Let's see if there's buying opportunities there actually. There are 4,000 homes. That's quite a bit of inventory. What this doesn't show is previous home sales from previous month to what it is currently. But we see that it's about 25% of homes that are price reduced. With that said, what can you get in Las Vegas? Let's do a quick math actually. So let me do some quick math and see if we can find a potential property and see if it makes sense over there really. This is one of the ways you could do this to calculate an investment opportunity, even if it's your first time home buying. Oh wow, and it looks like there's not that much multifamilies out there as well. Looks like most are single families. There's only 29. That's crazy. But yeah, whenever you're looking for properties, there are different ways you can do this math. What I typically use is FHA numbers because I know if it makes sense on FHA loan, it'll make sense for conventional as well. So I just want to show you guys a quick math in terms of how you can see if an area potentially makes sense for you. We see this is a duplex. Be the first owner. Each unit is identical with 3 bedrooms, 2 full baths, includes white shakers, cabinets, and such. So we see it's been on the market for 38 days and it has 39 saves. So there's an average, pretty much a good understanding of buyers and sellers. When you have a lot more saves than days on the market, then you know that the demand is super high. For this, I would say this is about average demand versus the supply that's available. So let's see what our payment would actually be. So it's listed for $750,000. The property tax is $200. Yes, that's one thing about Las Vegas is the property taxes are pretty low over there. So $750,000. Let's say we are doing $30,000 closing costs. So let's total this to $780,000. The way this works is that you're factoring your closing costs into the mortgage. It's called a seller concession, and you typically could do up to 6% when you're doing residential, and I believe 2% if you're doing more investment loans. So we're doing 3.5% down. FHA interest rates we know is at 6.375, but we're gonna shoot for the highest. We don't want no surprises. So 7%. Mortgage insurance is at $615. Property taxes is at 1%, which we know is a lie because it's at $400. It's not even that high. Let's use 0.25. Okay, so we'll stick with 2,000. Homeowners insurance. I don't know the area as much, but we'll use 3,500. HOA fees. There is none, but we always use the HOA fees. Instead of entering all these utilities separately, I would say that all the utilities come out to, since it's just 2 units, let's say $500 a month. So this is just 2 units and it's costing you about $6,600 a month, right? Now let's see the area. What would a 3-bedroom, 2-bath rent for in this area in Las Vegas? And this area is close to, right? So I'm going to zone here. So let's change this from for sale to now for rent. Reset everything, and we want to put 3-bedroom, 2 baths. 3-bedroom, and then the number of bathrooms is 2 plus. We want to use 3-bedroom max because we want to see exactly what this would get us right over there. So let's see. Wow, 1,700. Let's look at the middle. Once we get to a middle, you see our scroll get to the middle. So it's 1,800. Is how much you would rent a 3-bedroom, 2-bath for. This is not worth it, right? You're going from a $6,600 monthly payment and you're renting out 1 unit for $1,800. Where this would make sense is if you were living in one of them and it was double this price, so it was $1,800 times 2, so you were paying $3,600 a month, then I would say possibly you could look at it being worth it if you were thinking about living there. But from an investment perspective, if this is what you're going to get per unit, you're going to be under. It doesn't quite make sense. So we see why a lot of prices may have dropped over there. And it looks like Las Vegas too is not well known for multifamilies. It looked like it's more for single family type of situation. So I want to take a look at Seattle, see what Seattle is like right now. There are 200, so that's about 20%. But now let's go to our multifamily. Considering the scenario as I want to buy my first home and I want to rent out part of it and also be able to live in one unit out of the available units inside of the home, right? So there are 63 out of 1,000 homes in Seattle that are multifamilies. And that's also a bad outlook. I'm sure the numbers are probably going to be as bad as it was inside of what we were looking at before. Wow, this home has been on the market for 302 days and only has 36 days. If a house has been on the market for this long, that's usually a good indicator that people are not as enthusiastic. The demand is not quite there for this area. So let's break down the math to see what this is like. And the price dropped quite a bit. It went from 1.8 million to now almost 1.5 million. Property taxes is around 11,000 close. So principal and mortgage. So let's see. If we purchase this on an FHA, I doubt you'll be able to purchase a $1.5 million on an FHA. But just for the sake of us seeing if it makes sense anyway, we'll use those numbers. Mortgage insurance is already calculated for us. Property taxes we saw was around 11,000. But let's use a lesser number. So let's use 0.9. 13,000. We'll run with that because typically when you purchase a home for a higher value than it's currently being assessed for, they might raise the property taxes anyway. So let's run with that. Home owner's insurance, wow, 6,000 a year. So let's not lowball this. Let's go for 7,000. And the HOA fees, as we know, since it's 4 units, let's say $700 a month, right? So you're looking at your monthly payments as being $13,181. Let's see if this makes sense at all whatsoever. All right, so let's check this area that this was in. Actually, let me look at the map. This is around Central District, Madrona, it said. So let's see the map. Take out the filter Central District. So we are around here, right? See what rent goes for. So reset everything for rent. We want 2 bedroom, 2 baths, right? 2 bedroom. We're going to use the exact, and then it had 2 baths. And there were 36 available, right? We were at 13,000 and some for the entire deal to close down. So let's go to our middle area. This is being sorted from low to high. And if we look at our middle, it seems like 2 bedroom, 2 bath goes for an average of $3,000 a month, right? We don't want to be down here. We want to be further up. This is insane. This is worse than New York, actually. This is quite a bit. So if you have 3 units you can rent out, right? That brings you $9,000 a month. And then you have the unit you're going to stay in for free. Therefore, you're still responsible for about $4,000. Not worth it. For me, at least, I would see this as too risky of a deal. I wouldn't even bother doing it. And then you got Portland, Oregon. It's not an area I've checked. It looked like it's very far from everything else we've looked at. So let's look at Portland, Oregon. In places like that, they typically don't have as much. But for this one, they got more than Seattle and Las Vegas that we've been looking at. So Portland might be a good area to see if it works. All right, so we have 125 multifamilies. And out of this list, let's just randomly pick one to see if it makes sense. Right? Let me find something that actually shows how many bathrooms. All right, this one has 4 bathrooms. We'll do this. This one has 4 bedrooms, 6 bathrooms. Wow. So each bedroom got like 1.5 baths. That's pretty impressive. This is a much better use case of what you could see can work for you. And it's for $600,000. All right? Okay, so let's do math on this to see if it actually makes sense. Property taxes, it's not stating as much as how much it is, but let's see if we can pull from a nearby property. Let me see. What do they typically go for? Is this one stating 171? So they're like Vegas in a sense. So we'll use like $300 a year as the property tax, which is like almost nothing. All right, principal and interest. Let's say we are going to put our closing costs in here. So let's go in at 624,000, right? Because we can only do up to 6%. Interest rate, down payment is 3.5%. Interest rate is at 7%. Mortgage insurance, auto calculated for us. Property taxes is not that high. We're going to use 0.25. right? 1,500 a year, which is about right. If it's less than that, great. Home insurance, I don't know the area, but I'm gonna go with 3,000. HOA fees, again, we don't have any. I believe it doesn't. It doesn't have any HOA fees because it would have stated right here. But we're gonna use this as the utility. So instead of putting in each one of these, we're just gonna say, since it's a triplex, 500 a month, right? In utility. So right now your monthly cost is 5,300. So we're gonna go with 5,400 to round up as our total monthly cost. So if we can get 2 of those units at 5,400, that means each one would have to rent for 2,700. Then it's perfect. It's a deal, right? So let's see what area this is in, and we can try to see what rent go for around there. So this is in Powellhurst. This was the area that we were in, right? So we're gonna check in around here to see what rents go for. We're gonna reset everything, go back to rent, and we know that each unit was 2 bedrooms. What do they go for? Not that much. Let's go to the middle because our average rent will be around there. So we see it's like 1,400 for a 2-bedroom, 1-bath apartment. This to me, it doesn't quite add up. It doesn't quite add up at all because you're paying 5,400. That means times 2 of those units, you'll make 2,800, and you still have 3,000 and change to account for. To me, this is a bad financial decision that you wouldn't do. Let me find you a good use case because I've been looking in that area. So let's check actually, I think it's Atlantic City or New Britain. New Britain. Yes, it was New Britain, Connecticut homes. Bam. All right. A friend of mine's put me onto this area. So I've been slowly checking it out and see what's going on there. So let's only look at multifamilies. They only had 29 homes for sales, and about half of them multifamilies, which is good. It shows that there's a lot of multifamily population over there. So from here, let's see what our 13 results are. Look at the list of homes available, 6-bedroom, 2-bath. We want to try to get something with at least 3-bathroom, even 4-bathroom if possibly can. Okay, cool. So this one, good prospect. Been on the market for 25 days. It's 80 saves. That means demand is high up there, right? The days to the number of saves ratio, I always look at that to determine how bad the demand is for that area for that particular home. So it is quite bad. So let's take a look. $370,000 is our purchase price. Property taxes at $4,900. So let's go with adding 6% to this. So let's say we had $390. Right, that includes our closing costs because we want to do the seller concession to factor in a closing cost inside of the mortgage. Down payment, let's put it at 3.5% down. So you had $13,000, almost $14,000. Interest rates, we shoot for 7%. Mortgage insurance is already calculated for us. Property taxes we saw was at $4,900. So let's adjust this accordingly to make sense. All right, we shoot for a little higher, of course. So we use that ratio. Homeowners insurance, I'll go for $2,500. I'm not familiar with this area either, so I'm not too sure, but we'll shoot for that. And this, since it's 3 units, we'll go for $500. And the goal for a 2-3 family triplex is that you could live in one. If you're a first-time home buyer, right? You live in one, and you're taking advantage of the FHA loan, and you rent out the other 2. So we got all the math computed, and we are at $4,007 monthly cost. For this, I'll keep it $4,000 flat. So if each unit can generate $2,000 a month, I think this would make sense, or close to that. Then this would really make sense. So let's check what things go for in the area. So we're going to go for rent. New Britain is such a small place, so I'm just gonna not stretch this out. So we know they're all 2-bedroom units. And we go to our middle section here and we see that we're at $1,400. So $1,400 brings you $2,800, and the home we're looking at was costing us $4,000 a month. So this one too as well, not so sure about it. If it had another unit, then you could have gotten that third one completely rented, then you would have $4,200. Then yes, I would say it's a go. But this one, not so sure, because you would still be under about $1,200 because you have each unit going for $1,400 each, so that totals $2,800, and your monthly payment is $4,000. Therefore, you'd still be at a deficit of $1,200 per month from 2,800 to 4,000. So that might not be worth it as much. But let's see if we could look at another home in the area to see if there's anything else that makes sense. So let's look at multifamilies once again. But let's see if this makes sense. So we know each apartment has to be, if it's 5 bedroom, 2 bedrooms each. Let's just do a quick math on this to see how well does it make sense. The listing for sale is at $265,000. We add $20,000 to this for closing costs, so we are at $285,000. Down payment, let's say it's 3.5%. Considering FHA, interest rates is at 7%. Mortgage insurance keep as is, calculated for us. Property taxes was at $4,400. Yeah, we'll use 2% for this. Homeowners insurance, let's say is at $2,000. No HOA fees, but we're going to use that in place of utilities. Since it's 3 units, we use 500 as our number, and we are at total 3,200, about 3,200. So this is much closer to realistic because we know each 2 bedroom, 1 bath unit goes for about 1,400 times 2 brings you 2,800, and then your monthly cost is 3,200. So you are at a $400 deficit per month, which is not bad, at all. Considering that you're doing this on the FHA, you get to live in 1 unit and you're only paying $400. And remember that you also get a lot of deductions. You get depreciation. The property taxes are deducted through you as well. So therefore, you are going to be in a much better situation where that $400 in deficit is going to be even smaller because of those tax advantages that you actually have. So this one is good. So New Britain is not bad. But I do know one area that I've been poking around quite a bit, and that is Atlantic City, New Jersey, right? 3 apartments. Okay, so this one, much better look. It's for $300,000, and it has been on the market for 4 days, 9 saves. So it's not super huge demand that's going on over there. So therefore, you probably will have some leeway in the sense of what you're doing. So home purchase price is at $299. So let's say we are having a $20,000 home price to include our closing costs. The down payment is 3.5%. Interest rate is at 7%. Mortgage insurance calculated for us. Property taxes was at $4,100. So we can keep this. Home insurance, let's say, is at $2,000, and then no HOA fees, but we use that for our utilities. So $500. Since it's 3 units, we're at 26. Is this accurate? Oh no, it's not accurate because our listing price is $299. So $320 is what we want to look at. $320,000. So that should be like 1.5%. 4,800, 4,100. Yeah, it's close enough. All right, so our monthly payment is actually $3,300, almost $3,400. So we'll shoot for $3,400. So this house, triplex, 3 apartments, 2 bedrooms, it looks like 1 bath each. What can we get for over there? Let's do a quick, Atlantic City. Filter by for rent, reset all this, and 2 bedrooms, 1 bath. So it looks like 2 bedroom, 1 bath goes for, in Atlantic City, about $1,600, which is higher actually than what I've been looking at in the past months. So it seems like they've increased their rental that's going on over there. Let me shoot for this so it's not showing us anything that's more than 2 bedrooms. So let's see in the middle. Okay, so we're around 1,500. So it hasn't gone up. It's just had to refilter this down to make sure it was at a good point. So 14 to 1,500. So we'll shoot for 1,500 as our middle number. 1,400 would be a safe side. So we'll do 1,400. We know our payment was around 3,200 for that property, and we're bringing in 2,800. So this as well is another one where it makes sense, where even if you had a deficit of about $400, it's still worthwhile doing it. Because remember, rent is going to increase over time. The rent that I was collecting for me 4 years ago is not the same that I'm collecting now. If I do a math, I probably have increased by like 20%, 20 to 25%, because inflation has surged. It really spiked up during COVID because all the utilities went up, and had no choice but to also factor that in. So there you have it. That's pretty much the updates. As we can see, interest rates are still rising up, but they're staying stagnant between 6 to 7%. Commercial real estate is suffering a bit. They're being very tight right now because they're not sure. Some banks are collapsing that were linked to some of these like big commercial lending facilities, but there's a bit of drawback. They're being much more careful. We're not quite seeing what happened back in 2008 repeated in the same fashion, the same manner as well. So be very careful as you're looking for your next home. Do not put yourself in a situation where you know you're going to be in a deficit. That is my advice to you. If you want to get your single family, make sure you have enough cushion and money saved up, plus your job is able to put you in an ability for you to save each and every month. And I'll strongly advise that you don't do the single family, you do a multifamily for now, because that way you can offset your mortgage a bit, right? And then eventually in a couple of years down the line, you can refinance, sell the house, or even rent out the full house and then go move to your single family. Do it in that order. With interest rates being as high as they are right now, you want to offset your spending, your costs as much as possible and not try to overspend when you don't have to. If you're looking for commercial space, be very careful. Look at the industry that will be renting out your space. If you know that you're in a doctor's dental facility, see in the area that you are, or doctors and dentists, are they actually renting out as much, or are they doing their own practices somewhere else? See what's going on. Do your research, your due diligence. If you're trying to have a commercial space to build restaurants are thriving continuously, but make sure the demand is there. People are actually coming out, because we're in a different state of our economy than we were 3 years ago. This is not the same story that we're going through right now. COVID had shut down everything, and prior to COVID, things were at a normal pace, but COVID changed a lot of things where people are switching to virtual or even not renting out commercial space as much. So do your due diligence, be very careful. And I hope you found this insightful. If you have any questions for me or want to share some properties around for me to check out, I'd love for you to be able to do so down below. So I shall see you next time. Like, share, subscribe. Peace and love.